Okay. Now let's see the days sales in accounts receivable, or we call it as a day sales outstanding, or some people call it as a DSO. So basically what does this say? This simply tell you DSO, that how much days people take you to pay when the debtors become. So effectively these days sales outstanding, how much days they take. So if I go through the formula, so it's like average accounts receivable. On an average, what is your accounts receivable, and you divide that by net sales, divide by 365. So here if I need to calculate, I need to correct the formula here. So if we go above and see what are our average debtors, so we see and go to our balance sheet, and our closing debtors for current year is 120, opening debtors, or I can say previous year debtors, is 100. So this gives us the average debtors of 110. And what is our net sales here? Our net sales is $400 here. So 400 is net sales, 110 is the average receivables. So if we go here, uh, if we go here and see that what is happening, so you can say 110 is your what I can say average receivables, and this 100 was your net sales, which is shown here, and you need to divide this 400 by 365, so that you get the net sales of per day, which is 1.1. So effectively if you use this formula, you can simply say that you are having the debtors or accounts receivable for $110, and on an average your per day sales, if you divide net sales by 365, you are getting 1.1. so on an average your per day sale is $1.1 to them, and you are having receivables for $110. So on an average, how many days they will take to pay you back? So you will be saying they will be taking 100 days. So 100 days in a days sales outstanding, or DSO, looks very high. Now let me show you the same formula, or what you can simply do is like if we go above, I was discussing about this formula of accounts receivable turnover ratio. Now the accounts receivable turnover ratio was net sales divided by average accounts receivable. If you inverse this formula, you can say average accounts receivable divided by net sales. Okay, and here I can see average accounts receivable divided by net sales. Now you are calculating in days, so you can divide this net sales by 365. So it's just the reverse of debtors turnover ratio or accounts receivable turnover ratio, which I have told above, but the formula is simple like this. Or there is another way to think about it. So here if we see that our accounts receivable turnover ratio is how much, this is 3.6 times, right? So if we do one thing, remember this 3.6 times, okay? So our accounts receivable ratio was 3.6 times. So what we can do, 365 divided by accounts receivable turnover ratio. So if we divide 365 divided by accounts receivable turnover ratio, which was 3.6 there, then we will again get 100 days as our days sales outstanding formula. So this 100 days of days sales outstanding we can calculate through three ways. So you need to understand that question may come in any way, and you have to understand how to arrive at final numbers. Now let's try to understand why companies use a DSO. So they use it for the cash flow management. So it shows how long cash is stuck with the customer. Here the cash is stuck with the customer for 100 days, and this is critical for planning payments to suppliers, because when you will get the money from your debtors, then you will be paying to your suppliers, right? So it is very effective for planning payroll, suppliers, or investment payment as well. This is impacting the credit policy as well. If we are having high DSO, meaning people are paying you very late, they are taking 100 days, 150 days, then it means company is giving too much credit. A lot of money is on credit because a lot of delay is there. So the company needs to see if their customers are paying slow. This also means that If the DSO is low, it means the collections are very fast. But if it's too low, it may mean the company is being too strict and losing potential sales. So if the DSO is very low, it's like immediately within 1 to 2 days you are getting the money. It means that there may be some customers who want the credit, but you are insisting that no, we want the money immediately within 1 or 2 days, so the customers may be going out somewhere else. So the low DSO has its own impact and high DSO has its own impact. If we see the working capital and liquidity, this is used for cash conversion cycle, which we will be seeing later on. And finally, it helps the management to see where is the bottleneck for the cash recovery. And lastly, it helps the investors and lenders as well, that how to evaluate any particular company. Now let's see some real world companies example or cases. So what does this example involve? So if I take the Amazon and Walmart, so they have very less DSO, generally 0 to 10 days, meaning Amazon and Walmart get paid within 0 to 10 days. So because most customer pay immediately by cash, card or online, so these companies are cash rich companies because they are getting cash very quickly and the cash flow is very strong for them. If we see Apple's company, the DSO is usually 20 to 30 days because many of the sales are direct sales and Apple also collect very quickly and fast cash. But wholesale distributor may take some credit period because Apple give its phones to some distributors and distributors are selling it further. So distributor may ask for certain credit period, but they also have very less DSO. Less DSO, faster cash, faster I can say business. Uh, and then we see AT&T and Verizon, which is in telecom company. Telecom companies generally have DSO of 40 to 60 days because millions of customers take their, I can say, postpaid plans instead of prepaid plans. So when postpaid plans are taken, they pay their bills after 30 days and generally they take 40 to 60 days here when I show. So this is having a high DSO. So due to that, sometimes and many times their capital gets locked because money is getting delayed paid to them. And if we say finally see the Caterpillar Boeing company, heavy manufacturing industries, very high I can say capital intensive industries. So simply we can say DSO can be 80 days to 120 days. Why? Because the companies are selling Airbus, aeroplanes and bigger projects. So the customer pay a little bit more late and these are large contracts and milestone based payments. So generally there are long collection cycles. So this was all about DSO or debtors sales cycle or debtors collection period, I can say.